Good morning and welcome to Brookings. I'm Doug Elmendorf, a senior fellow here in the Economic Studies program. Brookings is pleased and honored today to be joined by two of the leading voices on economic policy in the United States, Larry Summers, former Secretary of the Treasury, and Chuck Schumer, the senior U.S. Senator from New York. These distinguished guests have come here at a moment of great risk and challenge to the American economy. The housing market continues to deteriorate at a rapid pace. Both housing starts and new home sales have now fallen about 50% from their peak several years ago. House prices have declined a little so far, but are expected to fall more substantially in the coming years. In addition, more and more borrowers are unable to make their mortgage payments. In the third quarter of this year, more than 16% of subprime mortgage borrowers were delinquent on their payments, up almost 4 percentage points from a year earlier. Almost 5% of subprime adjustable rate mortgage borrowers are actually facing foreclosure proceedings, more than double the reading of a year earlier. And overall rates of mortgage delinquencies and foreclosures are at their highest levels in at least 20 years. Moreover, most forecasters expect a notable slowing in overall U.S. economic activity. When Federal Reserve policymakers offered their projections this past February, they were looking for solid economic growth and stable unemployment both this year and next. Their expectations for this year have largely been realized, but storm clouds have clearly gathered for 2008, and some people think it is already raining. The blue chip consensus forecast from a few weeks ago shows real GDP growth barely above 2% in the coming year, and the unemployment rate rising. The odds of a recession have clearly gone up. At the same time, rising oil prices have fostered worries about inflation. These economic circumstances pose a substantial risk to the standard of living of American families. We've seen a variety of policy responses from the administration, the Congress, and the Federal Reserve. But there's an active debate about whether those responses are correct, are in the right direction but insufficient, or actually in some cases counterproductive and might worsen our economic problems. Our two speakers today will present their diagnoses of the nature and severity of the economic problems that we face, and will offer their own proposals for tackling those problems. Our first speaker will be Larry Summers. He will talk for a while and then take your questions. He'll be followed by Senator Schumer, who will also talk, and then following that, take your questions. Neither of these speakers really needs any introduction, so I will be quite brief. Larry Summers is the Charles W. Eliot University professor at Harvard University. He has served previously as the president of Harvard, chief economist of the World Bank, and undersecretary, deputy secretary, and secretary of the Treasury Department. Larry also has several connections to Brookings. He is a trustee of Brookings, a member of the advisory council of the Hamilton Project here at Brookings, and a co-editor of the Brookings Papers on Economic Activity, along with Greg Mankiw of Harvard and myself. This is a journal we edit that publishes policy-oriented research on current issues in macroeconomics. During his time at Treasury, Larry was a member of what Time magazine dubbed the Committee to Save the World, when he and Bob Rubin and Alan Greenspan dealt with the international economic crisis of the late 1990s. Like you, I'm eagerly looking forward to hearing his views about our current situation. Please help me welcome Larry Summers.
Doug, thank you very much for that generous introduction. When I once introduced President Clinton during the administration, and I worked hard on giving a generous introduction, the president responded by saying, "Larry, you have just demonstrated one of my first laws of political life. Whenever possible, be introduced by someone who you appointed to high office." Well, there's a kind of academic corollary to that, which is whenever possible, be introduced by one of your former students. It is good to be here at Brookings and to have a chance to speak today about our current economic situation. I believe that our current economic situation requires a comprehensive program of measures to contain the fallout from problems in the financial and housing sectors, and to assure sufficient policy support for economic growth over the next several years. Perhaps because of a failure to appreciate the gravity of our current situation and the problems our political process has in responding quickly and collaboratively to emergent threats, such a comprehensive program is not, in my view, either in place or in immediate prospect. For the last year, the economic consensus and the policy actions that have flowed from it have been consistently behind the curve in recognizing the gravity of the problems in the housing and financial sectors and their consequences for the overall economy. This continues to be the case. In my view, it is almost certain that we are headed for a period of heavily constrained growth, quite likely that the economy will experience a recession as technically defined, and distinctly possible that we're headed into a period of the worst economic performance since the stagflation of the late 1970s and recessions of the early 1980s. The late Rudy Dornbush was fond of remarking that in economics, things take longer to happen than you think they will, and then they happen faster than you thought they could. So it has been recently. The related but distinct patterns of excessive valuations in housing markets and excessive complacency in credit markets were pointed out for years by experienced observers. The cracks took longer to appear than many expected and have now proven to be far more structurally damaging than almost anyone supposed. Experience suggests that downturns like the current one, driven by falling asset prices and credit problems, tend to be quite protracted. Two extreme examples are the American experience after 1929 and Japan's experience in 1990 after the 1989 stock and real estate market collapse. Our last two recessions, associated respectively with the bursting savings and loan real estate bubble and the NASDAQ collapse, revealed gaps of several years between asset price peaks and the restoration of satisfactory rates of economic growth. Nationally, housing prices peaked less than a year ago, and credit spreads reached their minimum only about 6 months ago. History's caution that situations like the current one are likely to surprise on the downside for a considerable time and prove quite protracted is confirmed by forward-looking indicators regarding the economy. The text you have mentions many. I will mention just a few. The new and relatively crude futures market that predicts what will happen to housing prices nationwide suggests that before this ends, they will fall by 24% from their peak levels. And according to that index, the decline has only been 6.6% so far. The most important driver of U.S. economic growth over the past 7 years has been consumption, which has outstripped GDP growth. The combination of a near zero personal saving rate, lost housing wealth, reduced availability of credit, reduced real incomes caused by rising oil prices, a falling dollar, and rising food prices, as well as increased uncertainty, constitute a perfect storm, depressing consumer spending. Even looking 5 years out, markets suggest that the spread between safe liquid Treasury borrowing and the rates at which major financial institutions will be able to borrow will remain well above normal levels. The debt of some of our country's largest and most prominent financial institutions is now trading at levels suggesting that a market judgment that their odds of defaulting on their debts over the next 5 years approach 1 in 10. It is, of course, possible that the improved trade performance coming from the falling dollar, the working through of the Fed's monetary policy actions, and the remarkable resilience of the American economy will carry us through the next year robustly. But this is not, I would suggest, where the lessons of experience and the preponderant probability lie. Economic policymaking is about balancing risks. I've already suggested that the probability of subpar growth substantially exceeds the chance that growth will be robust. There is an additional crucial point as well. The adverse consequences of policy choices that fail to deal with a potential recession and fail to stimulate the economy, or that do not allow for financial repair, far exceed, I would argue, the adverse consequences of over-insuring against economic slowdown. Consider the costs if we experience even a milder than average recession. Losses of close to $5,000 in income for the average family of four, quite heavily concentrated among the disadvantaged, who were inevitably last hired and first fired, along with cutbacks in Medicaid, child welfare, and other social safety net programs as state budgets contract. A several $100 billion increase in our national debt and a significant reduction and cutback in investment in plant and equipment, education, and R&D. Hundreds of thousands more foreclosures and greatly increased risks to the financial system. Greatly complicated international relations as our downturn slows the rest of the world economy. The American economic model is called into question. Protectionist pressures rise, and the dollar's centrality to the international financial system becomes more in doubt. Of course, if a downturn turns into more than a historically mild recession, the risks are that much greater. Against these risks, what do those who counsel against what they see as imprudent activism worry? They fear that stating the need for strong action will somehow undermine confidence by laying problems bare, and they worry that inflation might tick upwards, or that those who've made financial errors will somehow be insufficiently punished. I only hope that history will see those as the main economic problems faced by whoever is elected President of the United States in 2008. It is the great irony of financial crisis that the very measures that could have prevented crisis are counterproductive once crisis comes. Of course, it would have been better to have had more fear on the part of lenders, less rampant liquidity, and higher savings 2 years ago when the imbalances were building. But that is not what we need now. The most urgent priority for policy over the next several months is containing the incipient economic downturn. I am convinced that it is possible to do this without giving rise to either excessive complacency in the future or accelerating inflation. I want to briefly sketch what would seem to me on current information to be the appropriate evolution of policy in a number of areas. Of course, as data comes in and alternative measures are debated, any particular combination of policies might look less and less appropriate. I will have served my purpose today if I've advanced the debate by contributing an example of an ambitious policy program. One former economist colleague whose advice I sought in preparing these remarks referred to recent events as adjusting for raised expectations, the greatest failure of risk management in financial history. This is perhaps too apocalyptic, but it is suggestive of the extent to which major financial institutions are unsure of their own and their counterparties' creditworthiness. In normal times, the spread between the rate at which the Treasury borrows and the LIBOR rate at which banks lend each other money for 3 months is typically well under half a percentage point. Currently, it is about 2 percentage points. In the United States and Europe, large and persistent spreads have also opened between the policy rates of central banks and the lending rates at which banks make credit available to each other and to firms and households. In this environment, the dominant risk is a downward spiral in which financial problems curtail credit and spending, thereby reducing economic activity, which in turn exacerbates financial strains, creating a vicious spiral. Once in progress, such a spiral may prove very difficult to arrest. It is much more important to establish credibility that policy is ahead of the credit crunch spiral than to reassure yet again that it is not behind the inflation curve. I say this not because I am unconcerned about inflation. The achievement of price stability over the last generation is one of the most important factors contributing to improved economic performance. It is a matter of balancing risks. With workers and firms as insecure as they are today, I see little chance of the kind of wage price spiral that has set off inflation in the past. Data on indexed and nominal bonds suggests that despite what has happened to oil prices and to the dollar, there has been no increase over the last year or two in the expected price level for the American economy in 2010 or 2011. Moreover, failure to contain a credit spiral could cost the economy several years of satisfactory economic performance. In contrast, if I am wrong and policy creates undue inflation pressures, they can be removed gradually at a moment of much less financial peril. So far, the Federal Reserve has responded by cutting policy rates by a full percentage points and putting forward a number of programs to make liquidity available to banks. The seriousness of the problems is suggested by the fact that liquidity provision has not yet made a large dent in the spread between bank and policy or government borrowing rates. Reductions in policy rates have, to be sure, translated into lower lending rates, but it appears that half or more of their impact has been offset by the increase in the spread between policy and lending rates. This means that the apparent easing in monetary policy in recent months has been much greater than the actual easing in credit conditions. What does this suggest going forward? First, it suggests that policymakers should consider focusing attention not on their traditional policy rate, but instead on targeting some more meaningful indicator of the cost of credit to households and businesses, such as the 3-month LIBOR rate. In this way, increases in credit risks will not, as they do today, automatically translate into de facto tighter policy. Second, assuring full transparency with respect to the valuation of assets and the recognition of losses and liabilities should be the top regulatory priority. The Japanese experience taught painful lessons about the dangers of government support and encouragement for measures that seek to rearrange balance sheets so as to avoid facing painful financial realities. Wherever possible, assets should be marked to market, not to model, and liabilities should be explicitly recognized. Third, regulatory policy needs to focus on assuring that financial institutions raise adequate amounts of capital to maintain their activities, even if this is painful for existing shareholders. If a bank is at the point of indifference between reducing the size of its balance sheet and raising capital by issuing shares or cutting dividends, the broader economy is not. Policy in recent months has devoted considerable attention to destigmatizing and indeed encouraging borrowing in one form or other from the Fed. In the months ahead, it will be equally important to destigmatize the raising of capital and indeed to insist that institutions raise enough capital to allay credit risks and permit the resumption of normal lending activities. The success of the Clinton 1993 budget plan in setting off a virtuous circle of growth, reduced deficits, lower interest rates, and still more growth, along with a growing sense that short-run stabilization policy is the job of the Fed, have reinforced the economics profession's growing aversion to the use of fiscal policy as a tool of economic stabilization. Yet, if economic data over the next several months come in as I fear they will, with increasing signs of recession, several considerations suggest that the policy response should include fiscal as well as monetary measures. Fiscal policy can work more rapidly than monetary policy, which has a lag of about a year between the change in the federal funds rate and its maximum impact. Moreover, the efficacy of monetary policy may well be diminished by capital constraints that limit the ability of banks to lend, or by creditworthiness constraints that limit the ability of businesses to borrow. As important, the extent to which monetary policy can prudently be used in the current environment is limited by concerns about the dollar, as well as about the bubble-creating effect of very low interest rates. Certain problems, such as the impact of mass foreclosures on affected communities, are not easily amenable to monetary policy. Fiscal stimulus, therefore, is potentially critical. But it can be counterproductive if it is not timely, targeted, and temporary. Gene Sperling's Bloomberg column this week makes these points strongly. To respond to an incipient downturn, fiscal policy has to have its impact in a timely manner. It has to be targeted to assure that increased government borrowing translates directly into increased spending and demand. And critically, it has to be temporary so that its effects are not offset by higher long-term interest rates. Indeed, from the point of view of stimulus, the optimal package is one that raises spending and the deficit in the short run while reducing the deficit in the long run, therefore bringing down long-term interest rates. Any fiscal stimulus program would have to be worked out in the context of events as they unfold and should be walled off from longer-term policy considerations where actions to assure long-term fiscal sustainability are essential. It is reasonable to suggest that stimulus approaching $50 to $75 billion, roughly in the range of 0.5% of GNP, is likely to be appropriate. The largest part of this stimulus should come in the form of tax cuts distributed equally among all taxpayers and recipients of tax refunds. Other elements of a stimulus package should include extension of unemployment insurance, given that long-term unemployment is already at recession levels, temporary step-up in food stamp benefits which can be executed and have effect very quickly, and tax measures to eliminate from taxation the so-called income that homeowners receive when they are foreclosed, this last step having just been passed by Congress. In the context of a legislative stimulus program, consideration should also be given to steps that can be taken to help contain energy and food prices. Such measures, if successful, would both raise consumers' purchasing power and reduce inflation concerns. They might include reform of the Strategic Petroleum Reserve to assure that the government stops the current practice of accumulating especially scarce oil products at times when markets indicate that current supply is selling at a large premium to future prices, as well as adjustments in policies promoting ethanol to assure that they do not have an excessively adverse impact on food price inflation. Probably the single most important thing that economic policy can do for homeowners is to minimize the risk of recession or the severity of recession if it comes. That is why the aggressive fiscal and monetary policy I have just discussed are so important. But it is also true that problems in the housing sector are an important reason for recession fears and need to be addressed. The recent teaser freezer, which freezes the initial teaser rate of some subprime mortgages, is a useful step that addresses that very small minority of subprime mortgage holders who, on the one hand, are unable to get new mortgages but with any real prospect, but on the other hand, can be confidently relied on to remain creditworthy with respect to their existing mortgages. It is a constructive step, but I know of no credible estimate suggesting that it will reduce annual mortgage payments by more than about $5 billion. It is a perhaps appropriate component of a much broader strategy that recognizes the core problems posed by the sharp decline in housing prices. While the issue of resets is an important one, there is a more fundamental problem that needs to be addressed. Consider a homeowner who purchased a home for $250,000, putting nothing or next to nothing down, implicitly relying on appreciation of the house to service the mortgage. That homeowner finds himself today with a home worth perhaps $220,000 and with the capacity to service perhaps $200,000 worth of mortgage, even before any rate reset. Yet if the house is foreclosed, its value will probably decline to $150,000 and adversely affect the neighbors as well. The best outcome for the borrower, the lender, and the economy is a write-down in the value of the mortgage that allows it to be serviced and at the same time prevents a mutually costly foreclosure. This is the same idea as Chapter 11 of the Bankruptcy Code that prevents the liquidation and enables the continued operation of overly indebted but viable companies. It is deals of this kind, not just in the subprime space, but in the Alt-A mortgage space and in the prime mortgage space, where foreclosures are reaching levels that were typical of subprime mortgages just a couple of years ago, that we are going to need to make if families are to be saved the agony of foreclosure and lenders are to maximize their resources. The answer may lie in bankruptcy reform. It may lie in standard templates for mortgage restructuring, or there may be other ways. Certainly, various tax and regulatory obstacles to shared appreciation mortgages, the mortgage equivalent of what on Wall Street are known as PIK bonds, in which lenders reduce month payment in kind bonds, in which lenders reduce monthly payments in return for a share in a house's appreciation when it is sold, should be removed. Until there is a recognition that many individuals who cannot meet their original mortgage obligations are nonetheless the highest value occupants of their homes, we are not going to fully respond to problems in the housing sector. Additional steps that should be taken in the next several months to ensure an adequate flow of credit to housing should include the provision of federal assistance to those who are foreclosed as they locate new rental housing, and to communities that wish to purchase foreclosed homes and convert them into rental properties. Support for an adequate supply of mortgage credit. Proposed increases in the availability of FHA guarantees are a positive development, though they are manifestly insufficient to assure an adequate flow of mortgage capital across the entire housing spectrum. The government-sponsored enterprises, Fannie Mae and Freddie Mac, should be granted significant temporary increases in their portfolio limit so that they can perform their market-stabilizing function at the time it has been most needed in 2 generations. They should also be freed on a temporary basis from punitive capital requirements, and the conforming loan limit should be increased to about $600,000. It is, of course, possible the developments in the housing sector will prove less serious than I fear, and that not all of these measures will have been necessary. How serious a problem would that be? A substantial fraction of the originators of subprime mortgages have already gone bankrupt. If I read the political winds correctly, those who remain will face greatly enhanced regulation. The concern that too many homeowners will learn from the events of the last year that it is a good idea to excessively lever up their homes seems less than paramount at this point. On the other hand, if policy remains behind the curve, families and communities across the country will bear the brunt of the errors. While it has not been my topic this morning, I trust that extensive efforts will be made to learn from recent painful experience. Most obviously and visibly, there's the need to protect vulnerable people from the kind of predatory lending practices that have been all too common in recent years. Recent experience also suggests that the need for reevaluation of traditional approaches to monetary policy, the regulation and provision of liquidity to different types of financial institutions, the role of the rating agencies, and much else. It has always seemed to me that those of us involved with finance bear great responsibility. There is the importance of well-functioning capital markets and the credibility of the currency. Much more important is the reality that when the economy is successfully managed, people's fortunes are determined by their own choices and efforts. When the wrong economic policy choices are made, people's lives can be wrenched apart as they lose their jobs or their homes or their ability to provide for their family because of complex forces entirely beyond their control. The economy is at as crucial a juncture as it has been in many years. Policy must balance risks at an uncertain moment. The lives of millions of people who will never think about countercyclical policy, moral hazard, lending facilities, or the federal funds rate will be profoundly affected by the policy choices made in this city in the next few months. I hope and trust that they will be made both urgently and wisely. Thank you very much. I am happy to respond until Doug gives me the hook to any questions. Yes. Why don't you identify yourself?
I'm Rachel Brown. I'm with EIR. We have this age-old phrase, the bigger they are, the harder they fall. And it appears as though the idea of putting more credit into the system is simply going to prolong the collapse and actually make it bigger. So I find it interesting that you bring up this rental proposal of attempting to freeze the collapse that's going on in the financial system. But I don't think it can be done without an increase of the productivity of the physical economy as well. This of the policies of Franklin Roosevelt, not the policies of Felix or Houghton. So I wanted to see what you had to say about that.
I'm confident that Felix Rohatyn regards his policies as being in the tradition of Franklin Roosevelt. And I'm not in a position to distinguish between Felix's views and Franklin Roosevelt's views, so I'll only speak to mine. It is, I think, a great lesson. In many ways, it is the central lesson of John Maynard Keynes, that when there is a shortage of demand in an economy, that shortage undermines the productivity of that economy. As plants that could be producing sit empty, as workers who could be producing output are idle, and that what is necessary, what is win-win for everyone, is to put them back to work. And that the capacity to put them back to work lies with policy tools that are at government's disposal. The use of prudent fiscal policy, the use of prudent monetary policy, the assurance of financial stability. And so in arguing for a macroeconomic policy response, I am very much oriented to supporting the productivity of the economy and maximizing its capacity to produce goods and services for the benefit of all citizens. Yeah.
Good morning. I'm Tom Palley. I'm an economist here in Washington, D.C. You began your comments with some references to the fact that a lot of people, for quite a while now, have made observations about the economy potentially running into the type of storm it's now run into. And I'd like to probe the implications of that a little bit. I think we all know that we need a really good containment strategy now, and that's how I interpret your own remarks. But the fact that we got into this mess suggests there's some deeper structural problems, which suggests we might need something of a deeper reform strategy. And the things that come to mind, sort of monetary policy and targeting asset price bubbles. I think trade policy has been a big part of this. The deficit has been a factor driving policy and creating some of the excesses. And some of the financial deregulation that, in fact, took place under the Clinton administration. I'm wondering, sort of along those sort of lines, this is a time I know that containment is needed, containment policy, but I think it's also a time when we should be thinking about reform policies as well. And I'd like to hear your thoughts on that, please.
I think the penultimate paragraph of my speech in the conclusion made essentially that point, namely that there was a great deal that had to be evaluated in terms of the failures of regulation, issues of the provision of liquidity, what can be done to respond to asset bubbles, the role of the role of the rating agencies, and so forth. And I don't presume to know what the right answers are to those questions. I think my own instincts would run towards focus on financial regulation, on issues of transparency, about risks, on finding ways of containing the procyclicality that financial regulation tends to give rise to. When things are good, capital goes up, and so people are strongly encouraged to lend more. When things go bad, capital goes down, and people are strongly discouraged from lending. And both kinds of reactions are counterproductive. So the finding ways to address that countercyclicality, that procyclicality, seems to me to be very much the essence of the question, as well as addressing a variety of kinds of non-transparency and information problems. I think that reliance on the rating agencies as a filter in evaluating risks appears much more problematic today than it did a year or two ago. Whether the current frameworks of monetary policy that don't focus on asset prices at all are appropriate seems to me to be an important area for debate. And there may be linkages between financial deregulation and what has taken place, although my current instinct would be that that's a harder argument to make. Yes?
Thank you, Mr. Summers. My name is Layla Magari, and I'm from the Mortgage Bankers Association. My question is, some advocates have said a good solution to the subprime problem is to change bankruptcy law to eliminate preference to first home mortgages. Industry thinks that this will raise rates for all borrowers by 1.5 to 2 points. What do you think?
I'm sorry, was the business about 1.5 to 2 percentage points was that your view? I didn't hear the source on that.
I believe that's coming from our association, the research done in our association.
I'm confident that I think the appropriate. I don't think the record of the mortgage industry in its lending over the last several years has suggested that it is entirely in strong position to evaluate the consequences of policy actions. Its predictive powers have not been well demonstrated. Or perhaps its predictive powers have been demonstrated negatively, as Senator Schumer suggests, by events. There are two kinds of moral hazard concerns here that people are very worried about, and I guess policy has to balance them, and I think the set of measures I'm proposing would. On the one hand, there is the concern that lending has created an enormous bubble, has been substantially underpriced, and that enormous bubble has given rise to great economic instability. The prospect that when there is hugely imprudent lending, it will prove difficult to fully recover from that hugely imprudent lending, will discourage such lending in the future. The principal policy concern of those who are worried about prevention, such as I suspect in the future, such as I suspect Senator Schumer and many in the Hill as they responded to the Fed's proposals, is precisely to assure that you do not see this kind of large-scale, imprudent lending that at times has a predatory aspect that we've seen over the last several years. On the other hand, the concern that you raise, which is that one wants to maintain a viable flow of capital and that lenders will only lend if they have reasonable assurance of repayment, and that if they lack reasonable assurance of repayment, they will lend at higher prices, is also a valid one. And those trade-offs are always present in shaping and structuring the bankruptcy law. But it seems to me that at a time when we're in entirely unprecedented and uncharted territory with respect to a class of loans, and when current arrangements are locking in enormous inefficiency with externalities through excessive foreclosure, that it is appropriate to be open to revisiting institutions and rules that were designed in an entirely different context. But I think if you read my speech carefully, you'll see that I was very clear in describing the kinds of restructurings that I thought needed to take place, and rather agnostic about what the right way to pursue them is. And it would seem to me that it would be very valuable for the Mortgage Bankers Association, with all their experience in this area and all that they've learned from the events of the last 18 months, not just to respond to the proposals of others, but to put forth constructive proposals of their own that would be judged by the standard of the scale of their impact on affecting the large numbers of homeowners who are affected by our current difficulties. Yes, Lee.
Lee Price from House Appropriations. I agree with your point about the limits of monetary policy given the financial system situation, and therefore we need to consider fiscal policy. But you also say it needs to be timely. We had you didn't talk about it, but we had fairly timely response movement on fiscal policy in 2001, 2003, but we had the same party controlling the White House and the Congress, and we don't have that now. So I'm interested in what you think how timely is timely. We've all got cloudy crystal ball about how things are going to evolve and when it's going to be needed or too late. But what is your sense of how quickly it needs to happen, and how did
the question
and how did you arrive at the 1/2 of 1% of GDP for what's the appropriate fiscal stimulus?
The questions were about fiscal stimulus. What's timely, and how do you get timely when the presidents of one political party and the Congresses of the other, and besides that, where do you get the number 0.5% of GDP? I'd say, Lee, that fiscal stimulus 2001 gets a good grade for timely, but gets a failing grade for temporary, and a failing grade for targeted. In the sense that it proved permanent, at least quasi-permanent, and most of it went to the groups in society that have the lowest marginal propensity to spend. What would timely be? It depends on the flow of data. If, as I hope is not the case, but fear may be the case, a recession starts to look like a very high likelihood, as we move into the midwinter and early spring, then I think it's essential that it be legislated and implemented within a small number of months. Whether that's possible in this political environment or not, there are others in this room who are in a better position to judge. What is the right level of fiscal stimulus? 0.5% of GNP with a multiplier combined with monetary policy action, combined with measures that respond to housing, seem to me to represent a firm response to downwards pressures. If the need for stimulus was a great deal less than that, I'm not sure the political effort involved in launching a stimulus program would be warranted. If the situation deteriorated further, I could imagine the need for greater levels of stimulus. But as the magnitude increased, my concerns about the ability of the political process to keep it temporary would increase as well. Yes.
Judy Kennedy, National Association of Affordable Housing Lenders. Thanks to all you did to support community reinvestment in 1999. We did predict this crisis in reports in 2001 and 2005 with the help of Ned Gramlich. And so it saddens us, frankly, to be in this situation. But now, where you weren't agnostic in terms of a lot of very sensible recommendations involve Fannie Mae and Freddie Mac. And I think the facts don't support those recommendations, and let me just tell you about a regulatory failure. Somewhere in 2004, Freddie Mac and Fannie Mae persuaded HUD to give them credit for affordable housing when they invested in AAA-rated tranches of securities backed by subprime mortgages. So they bought about half of all in 2004, more than a third in 2005. And the LA Times says they were the chief financiers of subprime excess. They have continued to get HUD goals credit and presumably will through 2007. So I want to come back to whether or not eliminating capital requirements that some people think they're going to burn through very quickly makes sense. And also, why recommend increasing portfolio limits when they're well under their portfolio limits and they can do more with mortgage-backed securities? Mortgage-backed securities require less capital. They involve less risk to the government. They allow lenders to do more. They allow home buyers to get more. But in fact, they're actually increasing their prices right now. They're not helping the market.
Thank you for those. Thank you for the compliments, and thank you also for those thoughtful comments. I hope it's clear from my track record that I am not without concerns about the government-sponsored enterprises, and certainly if one looks at the long sweep of history, the major policy problem is not that the government has asked too much of the government-sponsored enterprises. And I am not knowledgeable about, but am not surprised by your suggestion that the regulations regarding low-cost housing goals could be defined and enforced in much more satisfactory ways. Though that's not my subject today, that seems entirely reasonable to me. I think that as a matter of long-run prudence, there are a whole set of issues about GSE capital and about the scale of the GSEs that are appropriate to regulate. It does seem to me that one of their mandates was to provide a countercyclical element in the housing market. We are in the midst of what is probably the biggest crisis in housing finance since the Second World War. they are a major policy tool that has been put in place towards that objective. It seems to me that it would be a shame if the pressure from policy was for their contraction rather than for their expansion at such a juncture. If the particular set of measures that I spoke about are not the right ones to enable them to expand and respond at a moment when there's a shortage of credit, I am far more committed to the end than I am to the particular means that I suggested. Thank you very much.